Hello friends, welcome to Maverick Trades again. If you like the content, kindly like and share and subscribe to the channel so that you don't miss the new videos posted on the channel. And standard disclaimer, I'm not a SEBI registered financial advisor. Taking trades in stock market is a risky proposition. Kindly consult your financial advisor before placing any trades. Now, let's go to the topic at hand. All of us know that algorithmic trading has revolutionized financial markets over the past few decades, offering significant advantages like speed, efficiency, objectivity, and discipline. It allows the lightning fast execution of trades, taking full advantage of split-second market opportunities. It eliminates the delays and errors associated with manual trading, thereby leading to improved efficiency and reduced transaction costs. Since algorithms execute trades based on predefined rules and parameters, which eliminates emotional decision making, this objectivity and discipline reduce the impact of human biases and helps maintain consistency in trading strategies. Another main advantage in algorithmic trading, which we will touch upon in detail, is diversification and risk management. Now, algorithmic trading, inherently being automated, can be designed to diversify across different markets, different sectors, or asset classes. This diversification helps in spreading the risk and reducing the risk exposure to specific market events, thereby enhancing the risk management capabilities of your system. Benefits of diversifying trading strategies are well known, especially if they are non-correlated strategies. But then one question comes to mind. Let's say you have multiple strategies which perform differently under various market conditions. How then do you decide the capital allocation for each strategy? Is there a mathematical and logical method to do that? One of the ways to position size your trades is to use the Kelly criterion, a mathematical formula developed by John L. Kelly Jr. while working at AT&T's Bell Laboratories. The Kelly criterion is well known to be used by gamblers and investors for risk and money management purposes to determine what percentage of their capital should be used in each bet or trade to maximize long-term growth. After being published in 1956, the Kelly criterion was picked up quickly by gamblers who were able to apply the formula to horse trading. It was not until later that the formula was applied to investing. More recently, the strategy has seen a renaissance in response to the claims that legendary investors Warren Buffett and Bill Gross use a variant of the Kelly criterion. The Kelly formula that is in front of you has two key components: the winning probability factor and the win-loss ratio. Towards the end of the video, we will see how we will use this percentage to position size various strategies deployed in Tradetron. Bear in mind that this formula is used with the assumption that the investor will reinvest profits and put them at risk for future trades. The goal of the formula is to determine the optimal position sizing for any trade. To conclude, I will present the Kelly criterion in this diagram to better understand its concept. The center line represents full Kelly, as opposed to fractional Kelly, which can be at 33 or even 50% the position sizing. This line represents the portfolio return. As is evident, half Kelly betting gives 3/4 the return with much less volatility. The left side of the Kelly line is considered to be more conservative position sizing, and the right side is more aggressive position sizing. So what this concept suggests is higher than Kelly equity is used, then less return and more volatility is experienced, whereas a smaller positions sizing provides less volatility but less return. The optimum position is considered to be here, but you have to keep in mind that this theory is based on fixed variables and true probabilities, something that happens in a game of blackjack, which is based on 52 cards in a deck. The stock market has numerous variables, and as such, fractional Kelly would be considered the desirable approach should you decide to use this concept. Now, in the next part of the video, we will see how to calculate Kelly from backtest reports of Tradetron. Most importantly, in the interest of diversification, I need to make a disclaimer that any and all investors should think twice about investing more than 20% of their capital in a single investment or strategy, even if the Kelly criterion suggests a higher percent. Now, knowing the formula for Kelly percentage, let us assume that I'm having the following 7 strategies deployed on Tradetron. All right. Now, from where do we get W and R? That is total number of winners and average gain by average loss. These two details or data points can be easily obtained from the backtest report or even in a live deployment from the statistics page. Now, I will take a typical backtesting report in front of me. So if you look at this particular strategy, which has the backtesting report in front of me, all right, so here you'll have to look at row 7, row 18, and row 19. These 3 rows give you the required inputs which are necessary to calculate the Kelly percentage. Win rate, if you see here, it's shown as 66.67%. Rounded off, roughly it is 67%. So in the formula, we apply W as 0.67, as in 67%. R is calculated as average profit on profit days divided by average loss on loss days. In this case, it would be 1180 divided by 1045. So we'll go back to the Excel sheet. So let us take this particular strategy. Here, my win percentage was 54%, so I have represented it as 0.54. Average gain upon average loss. So on an average profit on a profit day is 4091, and average loss on loss day is 4033. This fraction gives you the R. Kelly is calculated based on the same formula as is shown here, which gives me a percentage of 9%. Now, you have to understand, when you have a number of strategies, all the Kelly percentages put together, when they are added up, they don't add up to 100%. They'll be slightly more. In fact, the more they are from 1, the better it is. For example, if this figure were 2, you would have easily been able to use the fractional Kelly, and you would be on the left side quadrant as shown in the picture before. All right. So in this example, my cumulative value of Kelly percentages is 1.23. The next step is we normalize these percentages in order to have a cumulative value of 100%. And that is simply done by dividing this figure by this figure. That's what we've done here. So we arrive at the final percentages of allocation for each strategy. So let us say I have a capital of 50 lakhs. So this percentage of this total capital is what I would allocate for this strategy. Now, to run one multiplier of this strategy, you require 1 lakh. Therefore, you can run approximately 4 multipliers of this strategy, right? So that's how you will change the multiplier setup in Tradetron to arrive at the total final allocation. So this is nothing but the rounded up value of the multiplier multiplied by capital required per strategy. All right. And once this exercise is carried out for all the rest of the strategies, you arrive at a cumulative value of 48.2 lakhs. So you set out to allocate 50 lakhs. Because of rounding of differences, you are now able to allocate 48.2 lakhs. So this allocation is the result of evaluating it based on the Kelly criterion. Hope you have understood how to carry out this simple calculation based on the Kelly criterion. If you have learned something, kindly like and share this video. Thank you all for watching. Have a good day.